In this example, we are going to look at and compare the traditional income statement with the contribution format income statement. We have a company that is a large retailer of surfboards. The company assembled the information shown below for the quarter ended May 31st. This information that you see in front of you is going to be used in the preparation of the traditional income statement as well as the preparation of the contribution format income statement. You can see where it lists information pertaining to our company in regards to revenue and expenses, which are the primary classifications that you will find on an income statement. The traditional income statements are pretty much prepared for external reporting purposes, as you have learned in other classes. Here's an example of the traditional income statement. You can see that we take our sales and we subtract out our cost of goods sold in order to end up with the gross margin. We also organize our costs into selling and administrative expenses. Then the gross margin minus the selling and administrative expenses equals our net operating income. The cost of goods sold that is reported that you see here are our product cost, the ones that are attached to the merchandise that is sold during the period. The selling and administrative expenses, however, are going to report all the period costs that have been expensed as they have been incurred. So how we calculated the cost of goods sold is by taking our beginning merchandise inventory from the left of $80,000, adding additional merchandise purchases for $320,000, and then subtracting out our ending inventory. That gives us $300,000 for cost of goods sold. Then we look at our selling and administrative expenses and our selling expenses. And before we can do that, we have to determine how many surfboards were actually sold. So we take the $800,000 that we had for sales divided by the $400 that we charged per surfboard that was obtained from the chart on the left, and we sold 200 surfboards for the period. So to calculate the selling expenses, we take our $50 per unit or per surfboard that is also listed on the left times the 2,000 surfboards. That is our variable cost. So then we have to add in the $150,000 of fixed cost for selling expenses, and we come up with $250,000. Then for our administrative expenses, we kind of do the same thing. We have $20 per unit times 2,000 units to get our variable cost, plus the $120,000 in fixed cost. Once we add the selling and administrative expenses together, we subtract that from our gross margin. It gives us a net operating income of $90,000. Now, although the traditional income statement is useful for external reporting purposes, it has some limitations when it comes to internal purposes. It does not distinguish between the fixed and variable cost. As you can see, we added them together to put on the income statement. So the contribution format income statement is used as an internal planning and decision-making tool. And it's going to separate our costs into fixed and variable categories. So first, we're going to take our sales and we're going to subtract out our variable expenses in order to get our contribution margin. Cost of goods sold is the same as we calculated on the previous example. Our selling expenses, however, are just going to be the variable portion. The $50 per unit times the 200 surfboards. And their administrative expenses, we're going to do the same, the $20 per unit times the 2,000 units. So once we add up all of our variable expenses, we subtract them out and we come up with our contribution margin. And then it's time to calculate the fixed expenses. The fixed expenses come directly from your chart on your left for selling and administrative expenses. They're still expenses and we still subtract them out and we come up with the same net operating income. However, this format allows us to see the breakdown of our variable expenses and our contribution expenses. The emphasis for this income statement is on cost behavior, and it aids in the cost volume profit analysis that we will be learning later on. The contribution margin is important. It's the amount that remains from your sales and your revenues after your variable expenses have been deducted. And then it will contribute toward covering fixed expenses and then toward profits for the period.